This is Trade Flow News, bringing you relevant news and insights from around the world. Trade Flow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. When Microsoft Corp made a massive purchase of carbon credits in January, it turned to a relatively new source: farmers who plant crops meant to trap carbon in the soil. The credits are financial instruments generated by projects that reduce or avoid the release of greenhouse gases, such as solar farms or tree plantings. The project's owners can sell the credits to companies who then use them to make claims of offsetting the climate impact of their operations. Microsoft bought nearly 200,000 of the farm-based credits at an undisclosed price, among the largest ever purchases of agricultural credits, as part of a larger deal to buy 1.3 million credits. But the tech giant rejected far more of the more than 5 million credits offered by agriculture projects because of systemic problems with measuring their climate benefit.
Oil prices rose 2% on Wednesday, after U.S. distillate inventories posted a large drawdown and refining activity picked up, boosting hopes for rising fuel demand. The market remained concerned, however, about India's surging coronavirus cases. Brent crude futures were up $1.23, or 1.9%, to $67.65 a barrel by 10:53 a.m. Eastern Daylight Saving Time, 14:53 GMT. U.S. West Texas Intermediate crude futures rose $1.31, or 2.1%, to $64.25 a barrel. U.S. crude inventories rose by 90,000 barrels last week to 493.1 million barrels, the Energy Information Administration said on Wednesday. Analysts had expected a 659,000 barrel rise.
Moving on to the top news in the energy sector.
China's imports of light cycle oil, LCO, are set to fall in coming months as authorities crack down on its illicit trading and sales in South China, dealing a blow to the $10 billion market and to refiners in top supplier South Korea. China's imports of the cheaper but more pollutive diesel blending fuel nearly doubled to record levels in 2020, but a clampdown in top oil-consuming Guangdong province has curbed demand. The amount of South Korean LCO, a refinery byproduct, to be loaded for shipment to China in May is down 60% from March, while spot premiums have halved, industry sources said.
U.S. crude oil stockpiles edged higher last week, rising less than expected as refiners ramped up activity, while distillate inventories slumped on stronger demand, the Energy Information Administration said on Wednesday. Crude inventories rose by 90,000 barrels in the week ended April 23 to 493.1 million barrels, compared with analysts' expectations in a Reuters poll for a 659,000 barrel rise. Net crude imports rose by 1.2 million barrels per day to 4.08 million barrels of oil per day, their highest since December, while crude production dropped 100,000 barrels of oil per day to 10.9 million barrels of oil per day, the AIA said.
Next, we have the top news in metal markets.
Global demand for nickel is expected to increase to 2.67 million tons in 2021 from 2.39 million tons in 2020, the International Nickel Study Group said on Wednesday. Global output of nickel is expected to rise to 2.72 million tons from 2.49 million tons, the Lisbon-based group said, adding the implicit market balance is a surplus of 45,000 tons in 2021.
Gold prices hit a near two-week low on Wednesday as investors awaited policy signals from the U.S. Federal Reserve. Spot gold fell 0.1% to $1,774.78 per ounce by 12:32 p.m., 16:32 GMT, after dipping to its lowest since April 16 at $1,762. U.S. gold futures fell 0.3% to $1,774.20. You're going to see the Fed affirm the dovish stance, and that should keep gold fairly stable, Edward Moya, senior market analyst at OANDA, said of the price movement. Fed Chairman Jerome Powell is expected to reaffirm easy monetary policy will continue for a prolonged period. We will now look at the top news in the agricultural sector. Russia is considering reducing its export tax on soybeans to 20%, but not to less than $100 per ton, starting from July 1, the Interfax news agency reported on Wednesday, citing a source familiar with discussions among officials. The tax of this size, if it is approved by the government, will be in place until September 2022, the source told Interfax. Russia's export tax on soybeans is set at 30%, with a minimum level of €165, $199 per ton, until June 30th.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.